Hi, this is Randy Finney with Right Side of the Chart, and today is October 24th, 2015. In this video, we'll take a detailed look at the broad markets. I've had quite a few requests lately on the site to do some or share my thoughts really on where I think the broad markets are going. As most of you know, my focus has been on trading individual stocks lately, ETFs, the gold miners, and I haven't posted a lot of market analysis at all. But I do think it is time where we're at some critical technical junctures, and so I'll get into that. This will be a bit of an in-depth review. I was going to break it down into different sectors, like the long-term outlook, the short-term, but it is also interrelated. I'll try to touch on everything quickly and wrap this video up as short as possible. All right, to really, before we look at where we're going, let's just look at where we've been and what has happened. So I'll do a quick review. I know I've had a lot of new people come into the site lately that haven't used the site before, so a lot of new followers, and I just want to do a rehash of what we've seen and what's happened in the markets in the last few months, because that does certainly impact my longer term outlook. What we're going back to here, we're looking at a post that was made on the site back on, let's see, this was May 13th. Now keep in mind the market, depending on which index you're looking at. For the most part, the stock market, U.S. equities topped on May 20th. The S&P 500 peaked on May 20th at a value of 2134.71. The NASDAQ, a little stronger. That continued to make new highs until July 20th. However, the most indicative index of really the U.S. stock market as a whole is the Wilshire 5000. That includes all market caps. In other words, the NDX and NASDAQ 100 are only large cap companies, and then it excludes certain sectors in the U.S. economy. The S&P 500, although it is diverse among various sectors, it only includes the largest market cap companies in the United States. That leaves out a whole universe of small and mid-cap stocks. So that's quite a few issues. All right, so what we're looking at is the post that was made back on May 13th, just a week before the market topped. And this one speaks to sentiment. In my analysis, I don't focus solely on trend line support resistance. I do a lot of that in the trade ideas that I post, especially short-term trading. If we're trading a breakout on a 60-minute time frame, a 15-minute chart, even a daily chart, in technical analysis, or I should say stock trading, swing trading, day trading, fundamentals, even sentiment mean very little to nothing. That really plays into the bigger picture, whether you're investing or trying to formulate your overall long-term bias, whether you're bearish or bullish. And that's why we're talking sentiment here and why it definitely makes a difference. It did back then, and I believe it still does going forward. So with that being said, this post, as I mentioned, was made on May 13th. You can reference that in the archives. And what I had pointed out here at the time is this extreme low reading in the CPC, the total put-call ratio. As the arrow showed here, we had only seen in the last, 6-7 years, the CPC drop to such extremes on 3 other occasions, including that one. So again, this one came, as pointed out, just a week before the market topped. The previous 3 over the last 7-8 years or so, whatever it was, resulted in a 55% drop, 17% drop, and 21% drop. I think where we're at now, I just did the math. I think so far from the highs that the S&P put in on May 20th to the lows on August 24th, I think it was about a 12.5% drop in the S&P 500. So that did play out. Now, what we're going to do is in a second here, we'll take a look at where we are today on this. What happened since that point, I should say. The other thing mentioned in that same post was the CPCI. That's the put-to-call index ratio, measuring puts versus calls on the indices, not just individual stocks or a combination of both. And we had this extreme that I pointed out right before the market topped back in, or shortly after, back in 2007. such an extreme spike. And then I mentioned on the same day back on May 13th that we had an even larger spike, something we haven't seen in many years. And that, of course, came just about a week or so before the high. So this, again, my point for this is it speaks to the sentiment had gotten complacency had reached such extreme levels, and from my experience, when you get these extreme levels, this has a lasting. These were building things, building sentiment issues. You could see the CPCI gradually trending down over the last few years. The market bottomed back in 2009, early 2009, which is right here. There was some fear, and then the fear just abated, and we started to see a little ramp up there. So, anyways, that's where we were back in May, and let's take a look at what's happened since. Okay, there was that May low, and from that point, as you can see here, the S&P 500 is low. The market topped, but it pretty much traded sideways most of the summer. We were in that trading range, and as I mentioned, the NASDAQ made a little bit higher high. The Wilshire 5000 traded sideways, actually triple topped over that time period, 3 consecutive tags at almost exactly the same level, very close. And what you can see is that was a shot across the bow, but it still didn't. That the extreme complacency continued. We had these quite a few other spikes down low on the CPCI, and even another reading nearly as low as that just before the plunge. So again, these are things that I watch, I factor into my analysis. I don't post these everyday updates, but what this says to me in the bigger picture, not only was there a warning shot here, I think that complacency has reached such extremes that there is more to come on the downside. In other words, this is indicative of a market top, is what I'm trying to say, not just a correction. Anything's possible, and we'll get into that in a second when we look at the charts. But I did want to point out, that it wasn't just this one extreme that I pointed out back in May. We had several other extremes before there, and you can see, we had such a violent drop, and that is largely a result of when everybody is extremely bullish. Complacency is this low. You have very little shorts. The shorts have just been blown out of the market. And if you only have longs, when you have these down days, such as we did that meltdown on the 24th, and the days leading up to that, you just don't have a lot of shorts in the market to cover that help hold it up. Along the way here, you do. So when the market's all lopsided, either too many longs or too many shorts, as we had back down here at the March lows, that's what you get. Okay, the first chart I started talking on was the CPC. We just left the CPCI, the index put-to-call ratio. This is the total put-to-call ratio. This arrow back here, that was the May 13th, when I posted on May 13th. Remember, 1 week before the market dropped. And just like the CPCI, that did very little. The complacency persisted. The market traded sideways all year. Everybody was... There was just a lot of complacency in place. And this arrow, I haven't even edited that arrow. That's the arrow I put back there at the time, and you can see that, it fell about exactly what I had drawn that out there. And I noted down here, it's been roughly a 13% drop so far from the May 20th highs that occurred right after that reading there to this point. Once again, take a look back in time. 21% drop here, roughly. 17% drop, 55% drop. And these were only single tags, so this is a cluster, months of persistent complacency in the markets, and that's why one reason that my longer-term bias remains bearish at this time. I think this is just the initial thrust down, just like in every bear market we've had. We had the tops back here in the U.S. equities in October, and of course we had that a rally. And there's always going to be bear market rallies along the way. We're not. I'm going to get into my trend indicators here in a second, and that will show that we really can't say with 100% confidence or any very high degree of confidence that we are in a new bear market. This may have been a correction. So I'm going to finish up on the longer term picture here, and then we'll zoom down to the shorter term charts, and I'll show you what I think will happen here in the very near term. So really some more actionable information will come at the end of this video. Okay, just a couple more things to cover, again, what has happened and how this may play out going forward. This was another post made on the site on June 8th. All the posts are stamped down here. You can use the archives to get to these, where I had pointed out some very significant technical events, some breakdowns. Title of that post, as you can see, is U.S. stocks breaking down. And again, I'll lead up to these charts. We'll do the follow-up here in a second. So at that point, I had mentioned, after pointing out these long-standing divergences, everything here on the chart, again, this has to do a lot for people who are new to the site and really don't know where my longer-term bias or market outlook is coming from. So I pointed out the breakdown in the S&P 500 here on this chart. I'm sorry, well, the NDX. We're looking at the NDX. Pointed down that was a key breakdown of this bearish rising wedge. I had listed 3 price targets, T1, 2, 3. We'll fast forward to today, see what happens. And then mentioning that the NDX was breaking down along with the S&P 500, which we'll look at in a second, and noting that these 2 large cap indices represent the bulk of the stock market. So when they go, so goes the market. Okay, fast forward to today, or I really should say to August 24th. This was in my NDX chart. This is the one available on the front page on the live links. And on August 24th, I had posted and stated that my final near-term target, if this is a bear market, we're going to have other targets, but this is where I posted on the morning of August 24th from reversing to a short to a long position because that target had been hit, and stated clearly that even if we are headed lower in the coming months, the odds for a bounce off this initial tag of support are very likely, and that's exactly what happened. And again, I'm referring to, you saw the same thing off the initial highs down back in October of 2007 when the market topped. You have that first leg down, and you have a bear market rally. That's just how it works. Things don't head straight down forever, and that was one healthy correction, especially in the amount of time that it happened. It was very sharp and steep, and you had to act fast. And that is why I reversed that morning and have maintained the intermediate term bullish bias of not posted or putting back on an aggressive long-term short swing position. I've just basically traded this range up and down, long, short, but mostly focusing on individual stocks. There were some long side trades on like TNA. I think we did 3-time long IWMs, stuff like that, official trade ideas, as well as some individual stocks. But I just wanted to point out this is why I've had that near-term bias, and that is starting to quickly shift recently for me, and I'll get into that in a minute. Okay, and this will be the last one from the past. This is the July 9th post U.S. equity markets overview. Again, remember the S&P's topped on May 20th. The NASDAQ continued higher to July 20th. So this was really made about just about a little more than a week before the NASDAQ topped, and the S&P kind of held up until that point. That was that whole sideways trading action. This was a very extremely comprehensive post, pretty much stating here that, read it verbatim, essentially we have bearish price action via numerous daily and weekly trendline breaks on all major U.S. indices, in addition to sell signals from the recently highlighted trend indicators. I went over that. There are several videos and static posts on my trend indicators, and stated that pretty much we were poised to have solid sell signals on just about every single major U.S. diversified index. One of the ones you can reference those again on the site. The post is July 9th down here. But this was one of the what I believe to be one of the more powerful and compelling charts out there. I've posted this one for a while. We're watching this, and I had these 3, really going back for the last 20 plus years, we've had 3 major, I should say very clear bull markets, 3 secular bull markets in U.S. equities. And again, I'm looking at the Wilshire 5000 because that is the most comprehensive index, including small, mid, large cap, a universe of nearly 5,000 stocks versus just 500 large caps like in the S&P 500. And although I've put up a similar chart with the OEX and the SPX as well, and you can see those bull markets all had something in common. They were all defined by a well-defined uptrend line. Walked up that. Those bull markets were officially over once those primary uptrend lines broke. all three bear markets, not only were they very similar in scope and duration, you can look at that. Here's the years down here. And this is how the markets work. They work in cycles. Bull markets typically run, the average can be, can range 4 or 5, 6 years. When they get past that, they're like this one, they're very long in the tooth. You also notice prices typically pinching or wedging. If you notice in the beginning of a bull market, price action's much wider. It starts to narrow out as the momentum wanes. You can see that. In other words, these are large rising wedge patterns. And then most importantly, you have these clear divergent highs. These indicators up top, the RSI making lower highs, the MACD or the PPO down here, which works a little better, making lower highs. So it was all laid out there in this. Finally, we had this primary uptrend line break. Waited for a couple weeks for confirmation. So, like I say, you always avoid the intra-week breakdowns like this little candlestick wick down here or the tail. Prices snapped back up, but over here we had several consecutive weekly closes. So followed by what? That's the big question. How much? We definitely had a correction so far, a very healthy one at that. But based on these charts, the long-term charts, that tells me that whether we go on to push up and make a marginal new high or not, I don't think we will, but it's possible. But even if we do, at best case scenario, my most bullish case scenario will be some slight new highs, maybe especially in the Nasdaq. We're almost there. But again, the Nasdaq is one index, especially the NDX 100. It's very, I should say, undiversified. It leaves out financials and other sectors, and not only that, but it's very top heavy in just a few components. I'll talk on that in just a second here. Okay, let's now look at the trends. We'll start with the short-term trends, zoom out to long-term trends. For those of you who followed the site for a while, I often put up, these trend indicators to help not only confirm the current trend that we're trading, also to help identify trend changes, as well as confirm or refute any breakdowns I see, let's say on a uptrend line or a horizontal support level. So when looking at price levels on charts, and if I see a sell signal, I'd like to see it confirm with the trend indicator. So where we're at today, I have this probably shrunk down, hard to see on the YouTube, so or whatever video thing you're watching here. So let's zoom in here. Short-term trend, as we can all tell, it doesn't take a rocket scientist to know in the last few weeks off the bottom, the short-term trend has been bullish. Again, I went to a bullish from a bearish to a short, going in short, reversing on the lows there, going to a bullish stance, and at the time stating that we'd probably see a pretty good rally, and it's what we've seen. And the short-term trend indicator has confirmed that. It took a while to flip to bullish, but it does remain bullish, at least by these metrics. I use different EMA pairs. One thing is when you have the 20-day moving average pointing up, that's a short-term bullish trend. So that's the near term. However, this can be sort of a lagging, not a lagging indicator, if you will, but I prefer in the short term. I'll let me say it this way: I'll be short long before this thing tells me that the trend is down. I'll look at some trend line breaks, other patterns, some things I'm looking at now, which again, at the end of this video, I'm narrowing it down to the shorter term time frames, and I'll give you my near term outlook on the markets. So you pretty much got my long term outlook at this point. Let's just finish up with the trends here. This is a big one. I put more stock into this trend here, the intermediate term trend. I've shared this on the site often. This pair, the 20 and 50-day exponential moving average, has just done a really good job over the years of defining the intermediate term trend. And this is where more you swing traders and investors would be interested in. If you don't want to follow all the short-term zigs and zags, a lot of intraday market analysis I post, this is a pair that'll help you stay long when you should be long, and either out of the market or short when you should be. You can see we had the trend. I have the 50 EMA pair just used in a 2050 pair down here in a histogram, and all that does, it shows me when these lines cross. This is a easier visual, and you can see we first triggered a sell signal back here, and the trend has been clearly bearish since. Now it's just flipped, at least on the S&P 500, it has just flipped back to bullish. So that's something to monitor. But though, although I always say there isn't any single perfect indicator, you can see the whipsaw signal here where it puts you on a buy and then back to a sell. If you really zoom in, there's a little red dot there, a brief whipsaw signal, a little whipsaw signal here. So far from perfect. When you get out to the longer term trend indicators, they tend to do a better job, and that's what we're working our way towards. Now, this is my weekly trend using a 17 and 43 EMA pair on the S&P 500, and this one has done a much, an even better job. Keep in mind, the shorter on time frames you go, when you go down to the daily trends, when you go to those short-term trends I'm using, the signals are going to come quicker, but you'll also have additional whipsaw signals. The longer you go out, fewer whipsaw signals, and this is just an excellent pair for long-term investors or trend traders to get long or short. This is going back 10 years, this chart here, and you can see, when it flips to green, it means you had the pair, the EMA pair right here, crossover, and that tells you that the trend is now bullish. So as you can see, it would have gotten you short back here, where if you follow the horizontal line, kept you short throughout most of the bear market from 2007 to 2009, and put you in, not right at the bottom, but got you in here, and you would have stayed long virtually the entire throughout the entire duration of this bull market since that signal back in early August there, or September, I'm sorry. And there was a brief signal here where it got you out of the market and helped you avoid some of this mess. So a little bit of a drawdown there, but not much, and would have put you back in and clearly kept you there. So again, the weekly trend is clearly bearish, not even close to crossing over right now. So this also helps formulate my view that we are most likely in a bear market rally. And now let's just look at the final go out. As I said, the longer you go out, the more effective the signals. This is a monthly trend, so this is even a longer term. This defines the primary trend in the S&P 500. And in addition to an EMA pair, I have the 10-6 monthly EMA pairs. I also like this ROC 13. I used to use the ROC 12, tweaked it a little. I think the ROC 13 gives you fewer whipsaw signals. So we're right there. Last month. Oh, keep in mind, with all trend indicators, you only go by the signal based on the period that those trend indicators from the chart that they're on. In other words, we're looking at a monthly chart. Whatever happens between now and October 31st does not matter. For example, last month through the end of September, we did have, for the first time since all the way back here, at least on the EMA pair, since back in that big correction, which was actually a bear market in the NASDAQ. We dropped over 20% there, and in small caps. Just missed that in the S&P, but that was the last time this indicator told you to get out of the market or the trend was down. So you can see that it has captured, just like the previous one that we looked at, the bulk of the bull market. And for the first time since the big correction / bear market in some indices back in mid 2011, we did on September print a solid monthly close. That's the red bars down here. In other words, the EMA pairs crossed. Yes, they've crossed back over right now, but I'm doing this video on October 24th, so we've got about a week to go, and anything can happen. So being that we're just barely above, you'd really have to zoom in to see the pair crossing. None of this matters until we get the October 31st print. And even then, it's not a hard line in the sand. If we close down, 0.02 above, it's just something to factor in, again, with your other analysis. Okay, I would be remiss not to talk on the NASDAQ, even though I talk a lot about the NDX and NASDAQ 100. This is the composite. I won't go through each and every one of these charts, but I did want to point out that the composite, the NASDAQ composite, not the Index 100, is still on an intermediate term sell signal using the 2050 pair. So we're close. We have much more upside, and this is a daily time period here, so we could in the next week or so flip to a buy signal. We've been on a sell signal since looks like late August. Little whipsaw there, but this has done a pretty good job as well. I just wanted to point that out. And if we look at the NDX NASDAQ 100, that actually did flip to a buy signal. I'm going to get to that in a minute here. I see some unhealthy price action. There's just a handful of stocks, particularly the large cap tech stocks, that have led this advance up, and that speaks to the breadth and the total oomph behind this rally, or lack thereof. We'll get to that in 1 second here. Long-term trend indicators, you can see the weekly trend on the NDX remains still solidly on a buy signal. This is the one case, I should say, the NDX and the NASDAQ, that has been in a bull market without any sell signals all the way since early, mid 2009. So you can see here this 43.17 EMA pair on the weekly chart has done a great job, and so far, if you've been long, you're a long-term investor, you're trading your 401k account, you want to know when to go to cash, when to stay long. Once this goes, this index, all the others will most likely be on those longer-term sell signals, and then at that point, I can say with the highest degree of confidence that I'd be able to say that we are in a new bear market. But we're not there yet, at least not on the NASDAQ. Let's take a look at the NASDAQ composite. Still on a buy signal on that weekly. Let's look at the Wilshire 5000, because that's a big one, as I say. This is more indicative. And the Wilshire 5000 is clearly on a sell signal, not even close to crossing back over. Again, this is the most representative index you'll find of the stock market, if you will. Okay, you know what? Looking at the time, the clock on this, I'll wrap this video up with where we're at now. We've pretty much covered my long-term view and outlook, or I should say my overall view on where we are in the market, where we're likely headed. And I'm going to wrap it up with just a little bit more on these trend indicators. I do think these are important. Here's my stock charts account. We were looking at TC2000 a second ago. Stock charts, although I believe TC2000 is a better platform overall, it has its limitations, and one of the biggest limitations is how far back in time you can go, and there's some other things. So I'm going to go over these trend indicators real quick. We'll wrap up the long-term view, and then the next video I'll hone down on the short-term, near-term outlook of the markets, where I think we're likely to go in the near term. Okay, this is the NASDAQ composite monthly. So these are the same trend indicators we were looking at before. You can see up on the top here, it's a 6 and a 10 EMA pair, and this has just done a phenomenal job. I don't think you can really, for as simple as this is, just two moving averages, you'd be hard pressed to find a better trending indicator. And again, if you're a long-term investor, trader, you could have done very well. There's no assurances going forward, but like you say, you're long when this is green, meaning when the 6 EMA is above the 10 EMA, and you're short when it's orange or red, whatever color you want to put there. And behind it, well, the price is down here as well. This is the NASDAQ composite, so you can see you would have caught that roaring bull market up. Wouldn't got you out at the top. That's why you use the shorter term trend indicators. That's why I use trend line breaks and other things, because I can guarantee you that I would not have waited to this cross, nor did I back then at the time. I wasn't trading professionally. I was a stockbroker at the time, but I was, long out of the most stocks by the time that trend indicator crossed, both personally and for my clients. So this is the crossover back in 2003. That's when the next bull market started. Got you in very early. So again, you can look at that. It's just done a really nice job. And where we're at now, as I mentioned, the NASDAQ composite has not even come close to triggering. It looks like these moving average pairs are, this zoom out here, we're looking at 20-something years, they're just kissing. So we've yet to see the NASDAQ composite trigger that long-term trends indicator, which will, if and when that comes, that will almost certainly come, because we are in a new bear market. I'm sorry. NASDAQ composite. This is just going down to the weekly, as I just covered again in the TC2000. This is the weekly 1743 pair. Also done a good job. If I put a black line here, that just shows you a whipsaw signal. You didn't really get hurt. You got out of the market, but then it got you back in. So the whipsaw signals had minimal damage, and again, you captured the bulk of the trend. You're just getting it in and out a little bit earlier with these pairs. So this is something I would really take note on if I see this 43.17 EMA crossover in the NASDAQ composite as well as the NDX 100. Most other indexes have already given us that. So let's go to the next one. This is the NDX, NASDAQ 100, as I mentioned. Still, the monthly trend indicator is still bullish, indicating that the NASDAQ's in a secular bull market at this time. There's the NDX weekly trend. Again, we were looking at the composite just a minute ago. Still bullish, yet to cross over. Again, this would be your first or next sign, I should say, that bear market is underway, but we haven't seen that yet, at least not in the NASDAQ stocks. And again, I'll speak to that in the shorter term video that I'm about to do here shortly. S&P 500, this is going back a long period of time. I think this is 15 years or so. Red and green just mark buy and sell signals. They mark all the crossovers. And as I say, I haven't added one here, but we just recently did have a crossover. Will it prove to be a whipsaw signal? That's yet to be known, but that does give me a little pause right here. I have to say, the fact that on the S&P 500 we do have now what they call a golden crossover, meaning the 20 is crossed back above the 50 EMA. So we'll see if that sticks. That may just be a short-term whipsaw signal. We don't know yet. All right. There's the monthly trend. As I said, right now, last month the S&P did signal the first sell signal on this indicator and going all the way back to 2011, and we won't know until October 1st or after the market closes on October 1st if we'll have a second consecutive close below. That would be a big deal because it would take the market would have to pull back pretty good within the next week for that to happen, and if it does, I will definitely increase my short positioning. S&P 500 weekly trend, 1743 pair, still on a sell signal, by a fair amount too. So again, this is the weekly trend on a sell signal. No reason at this point to believe. As I said, it's the NASDAQ is the one exception. We look at everything else: the small caps, the mid caps, the Wilshire, the S&P 500. Those are all on weekly sell signals, and that is why my intermediate to longer term bias right now is and has remained bearish for the last few months. Just trading the counter trend bounce long because the opportunity is there. That's all. Wilshire, again, very indicative of the whole broad stock market, and this is a monthly trend, and that is on a sell signal. Was last month. We still need to see how it closes this month. Another week to go. And then on the weekly basis, as I covered again, and we hit on this in the TC2000 charts. We're looking at stock charts here. It just goes back a longer period of time, and you can see the track record on this trend. So right now, clearly the weekly longer term trend is bearish on the Wilshire as well as most everything else. Okay, this has been Randy Finney with Right Side of the Chart, and as I said, the next video will focus on the very near-term outlook. There are some important technical developments. I think next week will actually be a make-or-break week, or has the potential to be a make-or-break week for the markets, and we'll get into that here shortly.